Hi, Assalamualaikum. My name is Farhan, and in this presentation, we will analyze the financial performance of Seng Industries Berhad for 2022 and 2023. We will look at the key ratios like liquidity, debt efficiency, and profitability to assess the company's ability to meet its short-term and long-term obligations. This analysis highlights how well Hubseng managed its operations, resources, and risks, provide valuable insight for investors, stakeholders, and management. Also, we would like to thank our lecturer, Madam Yasmin, for her guidance and support throughout this assignment. And a big shout out to our team members for their hard work and dedication, which made this project a success. Thanks to the resource we access, including academic materials and Hubsing financial statement. And now, let's begin our presentation.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Wali Basnuddin. Number ID SIT2T0T011. And today I'm going to explain about liquidity ratios. So liquidity ratios are a class of financial metrics used to determine a debtor's ability to pay off current debt obligation without raising external capital. Liquidity ratios measure a company's ability to pay debt obligation and its margin of safety through the calculation of metrics including the current ratio, quick ratio, and operating cash flow ratio. So today we're going to explain only two ratios, which is current ratios and quick ratios. Right. So given the structure of the ratio, the asset on top of liability on the bottom, ratios above 1.0 are sought after. A ratio of 1 means that a company can exactly pay off all its current liabilities with its current asset. A ratio of less than 1, for example 0.75, would imply that a company is not able to satisfy its current liabilities. A ratio greater than 1, for example 2.0, would imply that a company is able to satisfy its current bill. In fact, a ratio of 2.0 means that a company can cover its current liabilities 2 times over. A ratio of 3.0 would mean they could cover their current liabilities 3 times over and so forth. Moving on to the first ratio, which is current ratio. So to calculate current ratio, the formula is current asset divided by current liabilities. So we calculate for 2022, and then we got 2.05. For 2023, we got 2.27. Right. So Hubseng's current ratio was 2.05 in 2022 and increased to 2.27 in the 2023 fiscal year, indicating that the company can easily pay off its short-term liabilities. Rise from 2.05 to 2.27 implies that an improvement has taken place in liquidity, which has resulted either from an increase in current assets or from a reduction of current. Next is quick ratio. So the formula to calculate the quick ratio is current asset minus prepaid minus inventory divided by current liabilities. So for Hubseng, quick ratio of 1.58 for 2022 and 1.82 for 2023 established that the firm is rightly positioned to meet its short-term obligation with highly liquid assets. Right? As this ratio rises from 1.58 to 1.83, it indicates that the liquidity position of the firm has improved. This may be attributed to an increase in liquidity assets, or a decrease in the level of current liability, or both. Right? Also, this is indicative of the fact that quick ratio for Hubseng has ranged between 1.19 to 4.47 over the past 13 years. Thus, middle value of the ratio equaling 1.86 indicates that quick ratio for 2022 and 2023 years are well in line with firms' average in the past and liquidity stability. This might be considered as an assurance to large numbers of investors and stakeholders by the consumer packaged goods industry. So the summary table is there that you can see for ratio, for current ratio 2022 is 2.05 times, and for 2023 2.27 times. For quick ratio in 2022 we got 1.58 times, and for 2023 we got 1.83 times.
So let's move on to debt ratio. Debt ratio is a financial matrix that measures the proportion of a company's total debts to its total assets. It is just to evaluate a company's financial leverage and its ability to meet in-debt obligations. A high debt ratio indicates the company has a significant amount of debt relative to its assets, while a low debt ratio indicates that a company has a lower of debt relative to its assets. And for the second one is the debt ratio is an important financial matrix that is used by investors, creditors, and analysts to evaluate a company's financial health. A high debt ratio indicates that a company is taking on too much debt and may have difficulty meeting its debt obligations. On the other hand, a low debt ratio can indicate that the company has a financial position and is less risky for investor and creditor. And for the third one is the debt ratio is valuable for evaluating a company's financial structure and risk profile. If the ratio is over 1 and a company has more debt than asset, if the ratio is below 1, the company has more asset than debt. So the calculation of the debt ratio decreased from 33.7% in 2002 to 32 in 2023. This indicates a slight reduction in the company leverage, meaning it relied slightly less on debt to finance its asset in 2023 compared to 2020-22. A lower debt ratio suggests that the company has become slightly less dependent on debt, which can be a positive indicator of financial stability and lower financial risk. For the second calculation is the time interest earn ratio. The time interest ratio increased significantly from 1,375.3 times in 2022 to 3,260 times in 2023. It indicates a market improvement in the company's ability to meet its interest obligations. The higher time interest earn ratio in 2020-23 it suggests that the company is a lower risk of financial distress as it's more than enough earning to cover its interest payments.
Assalamualaikum. My name is Muhammad Hakim bin Zulkifli. Today I want to present a detailed analysis of efficiency ratio and profitability ratio for Seng Industri Berhad. These ratios are vital in assessing how well a company utilizes its resources to generate revenue and profit. By analyzing this ratio, we can gain insight into the company operational efficiency and financial performance. What is efficiency ratio? Purpose: analyze how well a company uses its resource, asset, and liability. There are four key components, which is turnover of receivable, inventory and machinery, equity usage, and liability repayment. Number 1. Inventory turnover ratio. Definition: gauges how efficiently a company uses its inventory. Low ratio may indicate weak sale or overstocking. High ratio suggests strong sale but possible inventory shortage. Number 2. Average collection period. Definition: the average time needed to collect account receivable. Low period indicate faster payment collection. Average collection period. There is a formula: AC receivable divided by credit sale and multiply 360. Number 3, total asset turnover. Definition: measure how effectively a company generates sales from its asset. Investor insight: help compare asset efficiency across company within the same sector. The formula is total asset turnover equal to sales divided by total asset. By using this formula, inventory turnover ratio equal to COGS divided by closing inventory. For 2022, we get 8.01 times. Using the same formula for 2023, we get 8.2 times. Average collection period. The average collection period for Seng Industri Berhad decreased from 45 days in 2022 to 37 days in 2023. This metric shows the average number of days it takes for the company to collect payment from its customer. For 2022, on average, the company took about 45 days to collect receivable from its customer. This period may indicate the credit term offered to customer and how effectively the company is managing its credit policy. For 2023, the reduction to 37 days in 2023 indicate that the company is collecting its receivable faster, which is generally positive as it improves cash flow. This could be due to stricter credit policy or more efficient collection process. This is the calculation method. Average collection period equal to AC receivable divided by credit sales multiplied by 360. For 2022, get the value of AC receivable and divide by the amount of credit sales, and we get 45 days. Using the same formula for 2023, and we get 37 days. Next, total asset turnover. Total asset turnover for Seng Industri Berhad remain constant at 1.5 times for both 2022 and 2023. This ratio measures how effectively the company is using its asset to generate sales. For 2022 and 2023, the company generated RM 1.5 in sales or every 1 ringgit of asset in both years. The consistency suggests stable asset utilization, meaning the company maintained its efficiency in using asset to generate revenue over these 2 years. Now we move to the total asset turnover of calculation step, which is sales divided by total asset, and the answer for 2022 is 1.5 times. In 2023, the calculation results show the same value as in 2022, which is 1.5 times. Profitability ratio. Profitability ratio are financial metric used to assess a company's ability to generate profit relative to its revenue, asset, equity, and other financial elements. These ratios are crucial for investor, creditor, and management as they provide insight into how effectively a company is operating and how well it is converting sales into profit. First, net profit margin. The net profit margin shows the percentage of revenue that remain as profit after all expenses, including tax and interest, are deducted. This ratio reflects the overall profitability and cost management efficiency of the company. Number 2, return on asset, ROA. Return on asset measure how effectively a company uses its asset to generate profit. A higher ROA means the company is using an asset more efficiently to produce income. Number 3, return on equity, ROE. Return on equity calculate the return generated on shareholder equity. This ratio show how well the company used the equity provided by shareholder to generate profit. The net profit margin shows the percentage of revenue that remain as profit after all expenses have been deducted. They increased from 8.20% in 2022 to 12.62% in 2023 indicate that the company has become more efficient in controlling costs and has increased in pricing power, leading to higher profitability. Here is the way of calculation. First, identify net income available to CS and divide by the sales, then multiply by 100 to get in the percentage form. That is the value for net profit margin. Net profit margin for 2022 is 8.20 and for 2023 is 12.62%. Return on asset, ROA. Return on asset measure how efficiently the company uses its asset to generate profit. By using the formula given, the rise from 12.25% in 2022 to 18.89% in 2023 suggests that the company is using its asset more effectively to generate higher return, which is a positive sign to improve operational efficiency. The last one is return on equity, ROE. Return on equity indicate how well the company is using shareholder equity to generate profit. The increase from 18.48% in 2022 to 27.80% in 2023 reflect that the company is generating significantly higher profit from the equity invested by shareholder, indicating strong financial performance and management efficiency. As you can see, just convert total asset at ROA formula to common equity to get the ROE value.
So for now, we're on the conclusions. Based on the analysis of Hub-Seng Industries Berhad financial performance from 2022 to 2023 is the company demonstrates strong financial health and operation efficiency, making it compelling investment options. Key indicators such as the current ratio and quick ratio show improvement liquidity, suggesting the company can comfortably meet its short-term obligations. The reduction in debt ratio indicates a more conservative approach to leveraging debt, contributing to financial stability. Significant improvement in the profitability metrics, including the net profit margin, ROA, and ROE, indicates that the company is effectively managing its resource to generate higher returns. Additionally, the sustained increase in the time interest earned ratio highlight the company enhanced ability to cover interest expense, reducing financial risk. Given these positive trends, Hub-Seng Industries Berhad appear to be a financial sound company with a strong management and growth positions. Therefore, I recommend investing in Hub-Seng Industries Berhad as it shows promising sign of continued financial success and stability. However, it's also important to consider external market conditions and conduct further due diligence before making any final investment decisions.